Closed captioning of this program is brought to you in part by Stan Wong of Macquarie Private Wealth. Active portfolio management for private investors. Visit stanwong.com.
We've been talking about the earnings for Walmart and for Home Depot. Walmart missing by a penny, expectations, and some conviction in the results coming out of Home Depot, beating by about 8 cents or so. Now, our next guest owns one of those stocks and sold the other. Joining us now is David Burrows. He is president of Barometer Capital Management. David, good to have you here with us. Now, you sold Walmart in about 2009.
Yeah, in 2009, we were very focused on things that were more predictable, selling into the low end of the market, staples, things that people were going to spend money on. As it is today, I think we're more in a world where you want to take advantage of companies that are getting some marginal benefit from the slow uptick in employment. And Home Depot fits in there with the renovation market, the auto market, areas like that.
So your bet when you sold Walmart, your concern was that the economy was actually picking up, that this was a stock that had become somewhat overvalued because people rushed into safety and staples. Is that
well? If you think about it, in 2009 we were coming off the lows. We were focused on things with very predictable cash flows, and yes, it would benefit from an uptick in GDP, but you weren't making a big bet on a much stronger economy. Really, in the 2010-2011 period, what you saw was strength more in industrials, where some of the tax incentives were bringing forward spending by corporations. You weren't betting on a big consumer spend, but some of the companies that benefited from capital spending for productivity. So that's really where strength was then. Now, as we move forward, we're moving into a world where with somewhat improving employment, you've got some pent-up demand. In some things that might have been considered more luxury, like, for instance, the auto market, where we're seeing a nice pickup in unit sales, home renovation, which is sort of the early phase of improvement in the housing market. And so small upticks in revenue mean upticks in margins and upticks in profitability.
So taking a look at the two results that we got this morning from Walmart and Home Depot, do those continue to fit pretty much with your strategy?
They really fit. In the case of Home Depot, they had not only improvement in revenues and comp store sales, so 6% comp store sales, 6.2% comp store sales in the U.S. They had improved margins. If you looked at their inventory came down, so they are selling stuff through. So there's a lot of tailwind there, and it doesn't have to be big for their earnings to work their way higher. In the auto space, you look at auto sales for the month of January, we're on a 14 million unit pace, which is ahead of expectations. So, old auto inventory in the marketplace now being upgraded. So this is, I think, one way to take advantage of some improving economic conditions, and then we barbell that against a focus in yield with dividend growth, which, it sort of looks at the risk-reward side of things and says we can get some total return with, pretty good predictability.
So you still like Home Depot. You got out of Walmart in 2009. What would make you want to get back into Walmart?
Well, the difficulty right now in Walmart's case is there's a fist fight going at the low end of the market. You've got the dollar stores on one side of them, and on the other side, their space is being encroached upon by people like Target. So they're really getting it from both sides, and you can't really expect significant growth out of Walmart because it's just so big that their margins are somewhat under pressure. So they're competing on price as it is right now, and that's really not necessarily where you want to focus.
Let's talk a little bit about some of the other things within your investment strategy. Dividend growth stock, energy, Baytex Energy is actually one that you like.
Yeah, so our barbell is let's get dividends that can give us some inflation protection. So where we get dividend growth, that's where you make money, dividends plus dividend growth. And so in the energy space, we got strong oil prices. Baytex is heavy oil. They've got a wonderful management team. They've got growth in their business, but it pays over a 4% yield. And so we think you get dividend growth there. We've been very vocal about talking about energy infrastructure, the growth and production out of the oil sands, 1.5 million barrels today, 4.5 million barrels probably 2020. Interpipe has lots of growth opportunities to build additional pipeline, push additional volumes in both liquefied natural gas and carrying bitumen. And so in both cases, you get a nice yield, plus you get dividend growth. And in this environment, there's a lot of people looking for yield. So that's a baseline in a portfolio, and then you put some of these tactical trades over top of it.
Would you still be a buyer of Interpipeline? I mean, you obviously bought a while ago. It's had a price run-up, as have a number of the other infrastructure plays. Would you still be a buyer at the current price?
So we are big believers in finding key themes in the market where you can see not only growth in revenues and earnings, but multiple expansion, right? So you've got an industry that has been looked at as a utility, as being boring, low growth, but you have a secular theme in volumes that's causing people to look back and say, well, maybe this is also, there's a growth rate attached to this that we weren't assuming previously. And so we think you can get a multiple expansion plus dividend growth, which can give you a geometric increase in price. So I think that's going to go on for quite some time.
Okay, and just quickly, you mentioned the auto space, you like Magna, but technology, Microsoft, and we'll leave it on that.
Yeah, so I think you can fit technology, large cap technology, into that dividend growth camp. 30% of the cash in the market is held on the balance sheets of technology companies, and CEOs are increasingly willing to pay that out to shareholders. So we've gone through 10 years of multiple compression in large cap stocks from 2000. Multiples are now starting to expand, and the dividends are expanding. It gives you a very predictable stream of revenue.
Maybe for 10 years. All right.
Maybe for 10 years.
David, thank you very much for joining us.
Thanks for having me.
We've been joined by David Burrows. He is president at Barometer Capital Management. Well, we shall be back in just a minute. We'll take a look again at our web question of the day and a few final thoughts. I think, retail.
Retail.
I think retail is our final thought.